Let's talk to Dave Harris. He is a CEO at Invatrust Consultancy. Very good morning to you, David.
Good morning, mate.
Okay, from my notes here, recent weeks a wave of worries hit the stock markets. Is it a wobble, stumble, or something more sinister?
Well, the recent sell-off, I think, has been brought about by turning off of the liquidity tap in the USA. You've seen the wind down of quantitative easing and the steady rise in interest rates. That has the effect of reducing the amount of cash in circulation, and thus it removes the catalyst for rises in share prices and the attractiveness of other investments.
Is it sinister?
Well, no, I don't think it is sinister, Nick. It's what you see from time to time. Markets ride a wave of enthusiasm for a particular amount of time. They then get a little bit toppy. People get worried. You get a sell-off. They then come down to a level again and people start buying again. I mean, that's very simplistic. I mean, economic factors come into it. But I don't see it as the word sinister, as you say, no.
Okay, so rising interest rates, generally, bad news for shares.
Yes, because with rising interest rates means that you get higher yields on government bonds. Effectively, that means you get lower prices on government bonds. And if you can get a risk-free yield from a government bond, or in this country a gilt, then why would you take the risk of being in the equity market for the same level of dividend return? I mean, if you take the US just at the moment, you can get a 3% plus yield off of US government bonds. And that's higher than risk-free, exactly. And that's higher than the majority of dividend yields on US shares.
Okay, so let's talk about the Federal Reserve in the US of A. Mr. Powell, he's obviously at war with Mr. Trump, or I should say the other way around. Why the sudden panic in terms of the yield curve, in terms of the interest rates in the US?
Well, I mean, there have already been interest rate rises, but I think where perhaps the Federal Reserve went a little bit wrong was they made an announcement that there were going to be further interest rate rises, which was not particularly surprising, but they were going to be imminent rises, and this went against really what Donald Trump had been saying in many of his speeches, you know, that we're doing great things for the American economy, and he doesn't want these rate rises because it will dampen down the effect of, say, the lowering of tax rates in the United States that we've seen from his administration.
Okay, so the FTSE at the moment is circa 6,900. How worried should we be?
Well, I don't think we should be over worried, and we certainly shouldn't panic. If you look in the UK, the FTSE at its height was round about 7,900, and it's round about 7,000 now. That represents about a 13% fall from earlier this year. If you look at the same period in the USA, it's about 7.5–8% reduction in the Dow Jones. And more importantly, I think, if you look out into the Far East, the Hong Kong index is about 20% plus down. It's the technology stocks. So if you're looking in the USA, NASDAQ stocks such as Amazon and Apple, which have frothed up. I mean, the returns on the NASDAQ index over the last few years have been tremendous. If you look in China, again, it's the technology stocks, it's Alibaba, it's Baidu, it's Tencent. All of these had motored forward. And again, look, in my view, they are the future. I mean, artificial intelligence, technology, that's not going away, but maybe they got too far ahead of themselves, and a pullback, I think, is perfectly healthy. Okay,
so stock markets go in cycles. Lots of people are suggesting we're in the ninth innings, sort of a baseball analogy. I think I've read 38% of economists are expecting us to be in the ninth, and by default, the US go into recession 2019, 2020. Where do you think we are in the cycle?
I wouldn't argue with the ninth innings rule, although if you say 38% of economists say that's where we are, 62% would disagree with it. And we've had this conversation about economists.
Yeah.
They're very good at looking in the rearview mirror generally, aren't they? So, but no, look, we have had this mature bull market since 2009 almost. There's been one or two little hiccups in the meantime, but we're certainly about there. I think that there are some tremendously rocky roads to manoeuvre in the next 12 months or so. Here in the UK, of course, we've got us leaving, or potentially, or if Brexit occurs. I mean, if you know better than I do on that, then please tell me. In the USA, potential trade war with China and other countries, all of those factors are not good for equity markets because they don't like uncertainty, and we've got uncertainty at the moment. Couple that with the fact that equity investors have done tremendously well for 10 years on the back of loose money, and it would tell you to be more cautious.
Understood. Okay, so I'm an investor watching this show.
Yeah.
What should I be doing?
Well, if you're an adventurous investor, let's say, you might decide, well, look, I've got this portfolio of stocks. I believe in this portfolio of stocks, and they're now 10%, 14% lower than they were 3 months ago. That's probably an opportunity to buy some more at a lower price.
But you're averaging in the wrong way, aren't you? Every textbook will say you should be averaging up, not down.
Well, they do, but I'm just saying that if they were good value at £1 and you believe in that company, then they must still be good value at 70p. If you're a more cautious investor, you'd go the other way and say that's precisely what you shouldn't be doing, because let's see when the rebound starts and then start to invest. So you're going to have two different types. I mean, me personally, I'm slightly more cautious than that. I would be in the second camp. And I think what you should have is you should have determined what the balance within your portfolio is going to be. You should certainly determine what your attitude to investment risk is, and your attitude will be different to mine. You've got to be comfortable, otherwise you shouldn't be anywhere near the equity market. Stick in cash, but when you've done that, believe in it and believe that equity markets will reward you over the longer term, and just forget these shorter term shocks. Okay,
so talking a longer term, what about my pension?
Well, your pension fund, there's not a great deal you can do about it. If you're somebody who's a little younger, you're making monthly you're making monthly contributions to your pension fund. You'll actually be buying stock at a slightly lower price. In 5, 10, 15 years' time, whenever it is that the younger generation move forward to retirement, all of this will be forgotten, and you'll have a pension of a proper level. If you're going to retire in the next 3 months, then I'm afraid you do have something a little more to worry about. You've either got to accept that maybe you need to defer your retirement for a little while until markets recover. For some people that's not possible, and I'm afraid that means they're going to have a lower pension. Okay, we're running out of time. Give me a conclusion, give me a summary. Well, my conclusion is don't panic. It's the old Corporal Jones, Dad's Army mentality. Don't panic. We don't know if this is a wobble, we don't know if it's a stumble, or we don't know if it's something more serious. But history would have you believe that when there is a mature market of round about 10 years and it starts to have a 10% fallback, the likelihood is that that 10% will probably go to 15 and it might go to 20. We will find a level at which people feel more comfortable with the level of risk going forward, and markets will move forward again. I don't think we're actually right at that point yet, but we're nearer to that point now than we were 3 months ago. David, always lovely to see you. Thank you very much. Pleasure.